Central Bank of Nigeria has once again tightened its monetary policy, raising the monetary policy rate by 25 basis points to 27.5%. This latest increase, the sixth of the year, brings the total rate hike in 2024 to 875 basis points. While the CBN aims to curb inflation with this move, experts warn that it could stifle economic growth and negatively impact businesses. New Central's perpetual Fasanmi-Peter had a chat on the show with Atiku Audu, Executive Director and Senior Trader, Vega Securities Limited, on this.
Right. Well, looking at this particular figure, I mean, the 25 basis point hike, I'm sure it was what you expected. But my concern or my worry now is the fact that businesses are already beginning to complain. What do you have to say about that?
Well, I think given the macroeconomic concerns, it was probably necessary to tighten at this point. But what I would say, the interesting thing is that the pace of tightening has slowed down. So it was 400 basis points in February. It's gone all the way down to 50 basis points at the last two MPCs, and now it's just 25 basis points. So maybe the positive message is that we're probably getting to the end of the tightening cycle, and from next year, perhaps there'll be an easing. And also, if you look at base effects of inflation, it is anticipated that inflation would come down from sort of tail end of Q1 next year.
Well, that's quite interesting. So what are the, maybe the pointers to what you have just said, talking about inflation? Because if you're talking about base effects, we still have PMS prices. We don't even know what the outlook is. Maybe you tell us. And apart from PMS prices, we have energy prices. We have some other things really that sort of price into inflation at the end of the day, whether you also want to look at the pass-through effects of foreign exchange. So what are the measures or the factors or indicators that would help us, reach that level you're talking about by next year?
Okay, so I think the one key point is sort of the common denominator across these things that you've mentioned, which is power, whether it's fuel, general commodity and cost of production, is really FX, right? And if you look at the last 3 to 6 months, at least from the statements that were made by the MPC, there's been some level of stability in that market. Also, the spread between the interbank market and the parallel market has sort of been shrunk. So given that we've seen that stability, it is anticipated that that would continue over time. The second thing I'd also like to mention is that reserves started the year at about $32 billion. Now they're about hovering around $40 billion or $41 billion. So we've got an accretion to the reserves of about $9 billion, which probably is sufficient to begin to put some more defense mechanisms against further devaluation of the naira.
Talking about defense mechanisms, the CBN doesn't sound to me or look to me like, it's ready to defend the naira, aggressively in that manner. Because I listened to the governor yesterday and he was talking about buffers, the importance of having this buffer for shocks and all of those things. So, what do you have to say about that? Because with this aggression, one would probably expect the CBN to intervene more in the market. But we're not really or necessarily saying that.
So there are different tools for defending the naira. So you could have either you could use the direct intervention for FX, or you could use the interest rate mechanisms. So perhaps the body language of the central bank or the modus operandi so far has been to use the interest rates whilst growing the reserves. Now that we've seen reserves accrue to a particular point, perhaps now the conversation is, okay, let's ease tightening for a bit. And if necessary, as and when required, we would gradually begin to intervene. Remember, the central bank cleared the FX backlog early on into the new administration's tenure. So obviously, the pressure has sort of reduced in that sense. So perhaps they don't feel the need to keep intervening, consistently or as much as you might have required. So I think the tool of the interest rate is probably the one that is at the forefront now. But that's not to say that as we move forward, if they see the pressures ramping up, that they wouldn't, tap into the reserves.
But for you, do you think these hikes have actually been effective? Because we know the trade-off is production, the trade-off is growth, and we know that businesses are growing. I know that when you look at the GDP figure, you feel like, oh, wow, that was growth. When you look at unemployment, you say, oh, wow, unemployment declined when you look at the recently released NBS data. But beyond these data, we are not seeing the effect in the real sector, in the wallets of consumers. Doesn't that bother you?
So understandably, we've had a significant devaluation of the naira, and I think that's probably what you're referring to. And that has been in spite of the consistent hikes by the MPC. The real, I would say, the elephant in the room is that of the fiscal side needing to step in perhaps a bit more. So the MPC has done what they can. You know, if we started the year with NPR at 18.75%, it's gone all the way up now to about 27.5%. That's almost 1,000 basis points hike, you know, in 1 year. You know, that's quite significant. So the MPC committee has done what it can to a significant degree. So now what we need the fiscal side to probably step in a little bit more or a little bit faster. You know, so what are we doing about the real sector? What are we doing about oil production? What are we doing about our export-led growth? How can we ensure that the business climate is better for the economy? I think that's where the key challenge is. That's pretty much the elephant in the room.
Does it seem to you that, you know, the structural impediments that actually that the CBN governor talked about are actually being addressed? Because he highlighted them. He talked about infrastructure issues. He talked about insecurity. Although the federal government and even the CBN governor keeps talking about, you know, insecurity being dealt with to a reasonable extent. And then he also mentioned the supply issues. What are your thoughts about this?
So I think a lot of those problems, they tend to be protracted and they require, should I say, a multi-pronged approach in dealing with them. Also, the second thing that I would like to mention is that those things take quite a bit of time for the results that we would like to materialize. So I would say while efforts are ongoing, you know, it would take probably some time for us to begin to see the fruits of the government's effort on insecurity, the fruits of the infrastructure investments.
But is enough being done? That's the question. Because you also talked about a fiscal side, saying they need to step up. Because all of those things, it's not just the monetary authority that has to deal with them.
I agree with you. And what I think Nigerians probably have alluded to, sort of similar to the points you're making, is maybe they'd like to feel the impacts a little bit quicker. So I think, you know, that's something that perhaps, you know, the authorities are doing the best they can to see how far they can go in bringing those things to fruition.
Okay,
but
so
yes.
before I let you go, I think it's important we talk about the capital market. What will be the impact of this on the capital market? What do you see happening?
So on the capital markets, generally speaking, I'd say usually with interest rate hikes, you tend to find the equity markets tend to have a bit of a slowdown because, you know, investors compare the dividend yields they could get in the capital market versus the interest rates they could get, you know, on a risk-free basis. So with interest rate hikes consistently, you might find a little bit of a slowdown in participation by investors in the capital markets. That remains to be seen. On the other side, in the fixed income markets, with the interest rate hikes, perhaps that would have an effect on fixed income securities where interest rates are already quite high. It might whet the appetite of investors to be able to see if they could get high yields. For instance, the 7-year bonds as high as 21, 22%, 1-year T-bill yields as high as 29, 30%. I think those things more or less would probably be attractive to investors as we move forward.
Well, for equities market, what do you think the playbook for investors should be?
So I think at this point, with the high interest rate environment, I'd say, you know, going for defensive stocks at this point in time, you know, names that you trust, names that are, you know, standard bellwether stocks at a decent price.
I want you to talk, you know, in terms of sectors now. I mean, sectors that will give us what we're looking for.
Okay, so I tend to look at things more on a price basis than necessarily on a sector basis, because you could have a particular sector, but everything there is overpriced. Or you could have a sector that you're probably avoiding, but there is a significant discount to value that can be attractive to investors. So my general playbook, for equities, would be to sort of guide investors along the line of conducting sort of their valuations and participating in instruments that are trading at a significant discount to their intrinsic value. And I think that's where value would be able to be extracted.
Right, interesting. So, I mean, generally speaking, I would like to get to hear your outlook for inflation, you know, for 2025 or even Q4.
Okay.
We're already in Q4 anyway, maybe just November. What are you seeing?
Yeah. So we started the year on the 29 handle, went as high as 34.15, and now we're sitting at 33.88. This is November, so we're heading into sort of Q1 next year. So if I were to hazard my analysis, I'd say we're probably going to have base effects kick in from January, February next year. And given that we've seen quite a large, you know, uptick in prices across the last 2-3 years, where inflation has been consistently double digits, you could begin to see sort of a base effects kicking and a bit of a moderation.
Don't you see, you know, some risks, some upside risks to these base effects and all that you're talking about?
Well, the upside risk would probably be something tied to FX, directly or indirectly. And if I look at the last 3 to 6 months, there's been some relative stability in the markets, hovering around 1.6
What about
to
PMS
1.7.
prices? What do you think about it?
So PMS prices hovering around 1,100 naira per litre.
Do you see it coming down?
Recently, it was on the headlines that Dangote is now offering that at about 970 naira per litre. So I think you probably have it hovering around these levels, although if by and large, and then perhaps there should be some level of moderation. As it was on the news recently that the Port Harcourt refinery has kicked in. I don't know if the additional
we heard
supply.
that. We were told that. Shunaya told us yesterday.
Yeah, exactly. Yeah. So that can probably also increase supply. Can lead to maybe cheaper prices as we move forward. So there are risks. There's no guarantees per se. But I think from the information available to us, it's very likely that inflation would moderate as we head into next year.
All right. Thank you so much, Atiku Audu, for your time on the show today.
Yeah, you're welcome. Pleasure.
Also, Nigeria's economic outlook for 2025 is a complex interplay of challenges and opportunities. Despite persistent headwinds, Zedcrest, in its 2025 Nigeria macroeconomic outlook, posits that the country's vast potential remains untapped. Again, News Central's perpetual Fasanmi-Peter spoke with Adeyemi Adenuga, investment research analyst at Zedcrest Wealth, on this.
Through that report, something came to me, and that's your optimism. It was so clear, and I'd like you to talk to me about this because many Nigerians are sort of wondering what the next few months hold, especially when you look at the elevated cost of living, I dare call it cost of existing in Nigeria, and that there's so much optimism in your report. Where is that coming from?
Okay, yeah, so some of the forecasts that we did in our report revealed that Nigeria's economy will grow by about 3.4% in 2025. That's an annual growth rate. I mean, that's an improvement from 2024, where we estimated it to grow at 3.2%, and then 2019, where we expected it to grow at about 2.9%. Now, what this means is that strategic sectors of the Nigerian economy is expected to grow as a result of strategic investments in those sectors. In addition to that, I mean, inflation. We've seen inflation hit all-time heights. I mean, currently, inflation is currently at about 33%. And then with inflation at 33% and interest rate at about 27%, we expect that when we get to next year, the high base effect of this year would begin to print into inflation, and then we'd see a lower pace in terms of inflation. For currency pressures, we've seen efforts from the CBN to make the currency relatively stable. And then as a result of that, we expect a stable currency at about 1,700 levels for next year. For interest rates, I mean, we expect a less hawkish CBN. I mean, we've seen currently, we've seen how the CBN exercised a bit of relief in terms of its hiking cycle. I mean, we saw just about 25 basis points at the MPC that held this week. And then what this means is that the CBN is beginning to see that inflation would begin to decline very soon. I mean, declining inflation doesn't necessarily mean that the prices of commodity would begin to go down. It just means that the pace at which the price of commodity will go up is just reduced. So, I mean, in terms of quality of life for individuals and people in the economy, I believe that fiscal relief should help them, and then the government's relief, I mean, tax reliefs and the likes should help stimulate buying interest and assist cost of living.
Well, that's predicated on, some of these reforms coming into place, especially the fiscal policy side reforms.
Exactly, yeah.
Absolutely. There's another thing. I'd like us to disaggregate this report a bit more. You anchored your optimism on anticipated policy shifts and structural economic changes. I'd like you to speak to that.
Okay. So anticipated policy shifts, I mean, policies in the likes of, so I previously talked about how we see a gap between the interest rates and the inflation rate. So currently inflation at 33%, interest rate at 27.5, that's a negative real return. But when we see that, when we go into, or when we get into the period of next year where we see declining inflation, and then why interest rates remains high, it means that we'd see a positive real return in that area. And then when we see a positive real return, it means that investors will begin to come into the economy. So that means that monetary policy would then show more impact on the economy. We would see foreign portfolio investors come in more. I mean, for the other sectors, the likes of the agricultural sector, the banking sector, and the likes, for the agricultural sector, we expect improvements in terms of funding from the Nigerian Agricultural Development Fund, and then also other declarations that the president has done earlier this year, which I believe would begin to show in next year I mean, in terms of mechanized farming also, we expect improvements in that light. And then for situations about access to funding, I mean, access to funding has been a significant thing that has held back agricultural productivity. So what that means from next year, we expect that improved access to funding for agricultural and for farmers in that light.
I see two issues here. Number one, you're talking about negative real returns and positive real returns. I mean, let's say positive real returns, you're talking about interest rates being higher than inflation rate.
Definitely.
Isn't that a problem for businesses? Because you're talking about foreign portfolio investments. I mean, these are people who are bringing in their dollars because of the value of the naira and all of those things, and because of our interest rates. But what about businesses? According to the Manufacturers Association of Nigeria, they are saying that over 700,000 businesses have closed shop. How many more do we want to close shop?
Okay. I mean, high interest rates is not always good for businesses.
Exactly.
Because it affects funding. And now, but basically one thing we've seen is that...
And then don't forget, we also see the crowding out of private sector in the capital market, in the debt market.
Yeah, so what we see is that, or what we expect, what we should expect is that, I mean, we have resilient business managers in Nigeria. We've seen the likes of major businesses like Unilever, Nigerian breweries and the likes. We've seen them manage costs. So we've seen Unilever, I mean, Unilever shuts about 2 of 9 of its plants, and then for the other 7 plants, optimize productivity there.
Shut down, say it very well, so that they will hear you very well.
I mean, it's a temporary shot. I mean, it's a temporary shot.
It's still something.
I mean, that's what Nigerian breweries did. I mean, it's a temporary shot. I mean, if you look at Unilever also, Unilever has also gone the light of discontinuing some unproductive segments, and then for segments that require a whole lot of foreign exchange to bring in those products. So as a result of that, I expect that we should see increased pricing. That's why I said inflation is going down doesn't mean that the price would begin to dip. It would just be the pace at which the price would increase would be reduced. That's what it means.
All right, so about GDP growth, you're talking about 3.4%. And I also remember since the Q3 GDP figures came out, one of the things analysts are talking about is this growth is not inclusive and it's not sustainable. So for your projection for 2025, is it going to be inclusive and sustainable?
The question of inclusiveness and sustainability. I mean, for sustainability, I believe that if we continue to fight the significant problems across sectors, I mean, the deregulation of the oil sector, I expect that it will improve productivity in that light. For the agricultural sector, in terms of the agricultural sector, I expect that, I mean, improved funding and the like should help agricultural sector to thrive more. Now, for sustainability, if we continue to tackle the major problems that affect these sectors, the likes of the funding, insecurity for agriculture, and then for other things that could affect all these sectors, I expect that I expect that we'll continue to survive in this light.
All right, so 3.4% GDP growth, how good is it for a country like Nigeria with its population? What does it mean for the everyday Nigerian? Because, I mean, sometimes we throw out these numbers, but there are persons who really want to understand what these numbers mean. So maybe if you could explain. I
mean, I would say it's just an improvement, particularly because of the pace of growth we've seen in like previous years. So in 2019, as I've said previously, we saw about, in 2023, we saw about 2.9% annual growth rates. In 2024, we are expecting about 3.2%. I mean, 2025, 3.4%. It's an improvement. Doesn't speak well about in terms of our productivity. I mean, increased price levels have really affected productive capacity. So as a result of that, we still see that a whole lot of some businesses are shutting down. But for the other ones that are still existing, they're trying to optimize their capacity to improve productivity.
For how much longer? How much longer? I mean, it's like we're testing the resilience of these businesses. I mean, for how much longer can we continue like this? Okay, you don't have to answer now, but you can answer if you want to.
So part of our outlook is that the monetary policy would begin a relief, or would begin to reduce interest rates from the H2 2025. So what that means is that we might see that the asymmetric corridor might a bit be relaxed, and then from that we see that we see rates in terms of like the key rates. We might see the MPR maybe like a 25 to 50 basis points in H2 2025. I mean, as that continues, as those relief come to place.
50 basis points is not small.
Yeah, of course. I mean, if you compare that to about 875 that they've done this year.
Okay, are you saying throughout the year?
No, I'm talking about, that's just an
Q1.
initial.
Okay, initial.
Yes,
okay.
initial. So, I mean, subsequently, as inflation continues to go down, we expect that the Monetary Policy Committee would begin to like cut rates.
Talking about inflation, you're projecting that we'll get to about 30% by Q1, and then by year end, you're talking 25.26. Don't you think, I mean, I'm just looking, how is that achievable? What are the things that will make that happen?
I mean, the major driver of inflation this year has been two things. One, the exchange rate, which we saw a devaluation of the currency earlier this year. And then the second one is the pass-through effects of PMS price increase. Now, for the exchange rate, we expect relative stability, particularly because we expect improved supply in that light. For the other part, which is the PMS price, we've seen that increased PMS price have been priced into commodities. That's why, I mean, prices of commodities will remain elevated, but that doesn't mean that the prices would begin to decline. That means that the prices will remain elevated, and then if the prices remain elevated, it means that inflation will continue to moderate. And then the high base effect also contributes to that. I mean, if you look at the high base effect, we are going from a period of high inflation in 2024 to a period where we expect less impact of PMS prices and exchange rates on the inflation figure. So as a result of that, I mean, we expect a decline in that light.
All right, thank you so much. I think at this point, I'll just have to end this conversation. Even I would love to speak to you about debt service to revenue ratio, but we have to end it here. Thank you so much for coming on the show today.
Thank you for having me.
All right, it's been a pleasure speaking with Adeyemi Adenuga, Investment Research Analyst at Zedcrest Wealth. Bye for now.
And that's the size of our package on Business Edge. Many thanks for watching. I am Lekon Onabanjo.